Hello, and welcome to the Safri Private Wealth Podcast. I'm Leonora Stevens, a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
So, what is the topic of our discussions today? Well, we thought it might be useful to discuss the topic of gifting property, whether it be your main home, a share in your main home, or a second property. This does seem to be an increasingly discussed point with clients, and you may wonder why. Well, it's often discussed when people are looking at their potential inheritance tax position, what it may be on death, with the main home sometimes being the largest element from a value perspective of some people's estate. Additionally, with the property values going up, the nil rate ban for inheritance tax has been £325,000 for many years now, whereas actually you can get up to £500,000 if you're transferring your main home to a direct descendant. Then it's more likely that people's estates will be caught and thus suffer IHT. And a key issue is then how do you fund that IHT when the main value is tied up in the family home, which is an illiquid asset? Today, we'll talk about the tax implications or things to consider should you wish to think about giving away your main home, a share in it, or a second property, whether that be a holiday home or just another property that you have in your portfolio. I would caveat that we are recording this before the budget on the 26th of November 2025, where there may be changes announced to lifetime gifting, property taxes, and potentially stamp duty land tax. Therefore, what we are covering today is as the law stands as at September 2025, so may be subject to change. If you're considering any of the options we discussed today, I would highly recommend you speak with your tax advisor as soon as possible. So, Mike, should we start with giving your main home? What are the tax implications of giving away your main home during your lifetime?
Well, it's one of those, Leo, where you have to rattle through all of the taxes, don't you, with your fingers and thumbs and toes. I don't think you need your toes. So to start with, even though you're making a gift, that's a capital gains tax disposal. If it's your main home, chances are that all or some of the gain at least, but let's a simple situation, all of the gain will be covered by your main residence relief or principal private residence relief. So capital gains tax should be one you can tick off. Inheritance tax, and if you're making a gift to another individual, it's the rule that most people are aware of: survive 7 years, and then it falls out of your estate for inheritance tax purposes. But I guess going back to budget, there has been talk about 7 years becoming something longer, so that's a bit of a wait and see. But currently 7 years. The main one is going to be you can't continue to live in the house. Otherwise, you have this horrible thing called a GROB, or gift with reservation of benefit. So as long as you are enjoying the asset, even if you don't own it, it's in your estate for inheritance tax purposes. So that's a real nasty, so big red flag on that one. And the last one, which sometimes people forget, if your house has got no mortgage, fine. If there is a mortgage and you give the whole lot away, then effectively the person you're giving it to is taking on the mortgage, and that is consideration. So it's no longer a gift. So those are the main four implications. So even that, we've said give away your main home, and we've already identified 4 areas you need to look at. Yeah, tricky stuff, even in the simplest situation.
And I suppose also you need to think about it from a practical perspective. It's a great idea saying, I have a very high value house, I shall give it away to my children. But where are you going to live? Do you have other funds that you can use to rent somewhere or to buy another, or you might have another property, but you need to think practically, where will you live? And the other thing also is, I've seen from experience where the parents give the property to, say, they've got 4 children, and mum and dad continue to live in the property and pay market rent, which can be quite an effective way of sort of eating down their cash reserves and putting it in the hands of the children, albeit that rent would be taxed on them. But then when mum and dad die, then how do you split an asset like that? If you have 2 that say, I want my money out, the other 2 say, oh, we want to keep it for the family for many years. So it can cause divide. So I think, again, from what we've often said in our podcast, communication is really important, and it's really important for mum and dad to discuss those things at the time of doing it to make sure that the family doesn't fall out in years to come. And one other sort of practical point, where a property qualifies as your main residence, even if you move out in the 9 months pre-sale, that period is still covered by your main residence relief.
Yes.
Whereas something that is maybe applicable to older individuals, where potentially they might move out of their main home into a care home, And at that point, they think they might go back into their house. They don't want to sell it. That final period of deemed occupation is actually extended to 36 months. So there isn't quite so much rush if they think, oh, actually, I might move out. But ultimately, they stay in the care home and they decide at that point to give the property to their children. They could still qualify for full relief, even if it's longer than the 9 months. So that's just something to bear in mind. Moving on with my practical points, I think also we said that there are a few red flags here, but it's worth weighing up. What is the implication of you holding it till you die versus giving it away and surviving 7 years? If you held a property at death, then you would have a 40% charge on the value above your nil rate band. So as I said before, so you have a £325,000 limit, and that's increased to 500 if you're giving away your main residence to a direct descendant. So that's great. So you can give up to 500,000, but if you have assets over 2 million, then that's abated as well. So if you sort of look at a calculation, if you've got a married couple, civil partnership, they own a property jointly, it's valued at 1 million or less, and they transfer all those assets on death to their next generation, and their total assets are worth less than 2 million, then there would be no IHT on the house. So you don't need to worry about doing any planning or thinking about giving during lifetime because there's not a concern. But it's where property value is over 1 million that you then start to think about that IHT. And Mike, have you got any sort of practical tips about spouse transfers that can help mitigate the IHT?
Yeah, there is the one, and it sounds a bit morbid, but if you have a dying spouse, and this applies to other assets as well, and you want to rebase, the spouse who is going to survive can give assets to the dying spouse, who can then leave them back to the surviving spouse via their will. So sounds a bit morbid. Someone's dying and you're, as well as all the emotional stuff, thinking about assets and capital gains tax, inheritance tax and all of that, but perhaps something to think about.
It does feel slightly risky, and also, as you say, slightly morbid thing to think about while someone's on their deathbed.
Yes.
And also with the impending budget, there have been rumours previously that will they remove that uplift in base cost to market value or probate value at the time of death, and if that goes, then obviously this deathbed planning option wouldn't be so attractive. So I wouldn't say it's simple giving your main home, but there are a few things to consider. It can be easy, but there are various quirks that might catch you. So definitely worth speaking to your tax advisor. But if you've got, for example, clients where they have a large house, large gardens, what would be the tax implications if they decided to give a share in their home to, say, one of their adult children?
Well, the principles before taxes, CGT, IHT, SDLT, stamp duty, land tax, are the same, but there is an exemption if you give an undivided share in land, which sounds very grand, doesn't it? But all that means is that you're both going to be in occupation. So donor and donee both are in occupation. And I have heard a tax barrister say, well, occupation could be along the lines of, you've got a student child who only comes home once in every blue moon to have their washing done. Is that occupation? I don't know, discuss. In that case, a gift means that the asset comes out of the donor's estate. So that does work for inheritance tax purposes, as long as the donor doesn't get a benefit from that. So generally that would mean splitting household bills 50-50. So that can work, but you both need to be in occupation of the property. An undivided share, I think, I'm a lapsed lawyer from many years ago, but I think that means that you've not both of you occupy the whole of the house. So you're not really saying, well, you're on the first floor and I'm on the ground floor, or whatever it might be. So that's something in there.
I suppose there's also things where they will have, you'll have a client that might have very large land attached to the house. Do they think about giving away that part of land that mum and dad might not enjoy anymore because they can't get around? Or have they got a swimming pool, tennis court that mum and dad can't really use anymore? So do they pass? How would that impact the value? Would be something that would be considered. But
just can you carve it up? Yeah,
exactly. Can you carve it up? And when it comes to, I know when my parents had their house redone, they made sure that the ground floor was very self-contained, so they could probably live in it, and you could carve off the other floors.
Yeah.
But it's thinking through all those different options, and therefore the implications of bills and the practical issues.
Yeah,
it's only something to consider. But have you had any clients actually do a transfer of any kind like that?
Actually, my mother and sister, who lived together until my mother died at the beginning of last year, were in that arrangement. That worked. The only thing is, when I came to do the probate, could I find anywhere on all of the forms on HMRC's website any reference to this? Answer, no, I couldn't. So it's another example of, well, you need advice, don't you? Because going through the forms as a layperson on your own, I don't think you would ever have found it, because it is a bit obscure, but it's there nonetheless. So personal experience, I've never advised a client on it, but I have, as I say, had it come up in my own family. So it does work. Probate came through very, very, very quickly. I know we've talked previously about probate can be a thing of years and years and years, but probate in that example came through very quickly.
Oh, very good. I suppose I've seen it more where people have been discussing not giving away their main home, but giving away a share of a holiday property that is slightly easier to identify the usage and the split of costs just due to the nature of the occupation. But that brings me on nicely to discuss the tax implications of transferring a second property or holiday property that isn't your main home to your children. So if you hold other residential property that you don't live in, are the tax implications very different to giving away your main home?
Well, they are, I suppose, because we've talked about main home being covered by principal private residence relief, main residence relief. A second home isn't going to be. So you are then talking about 24% capital gains tax at current rates on whatever the gain is. And the gain, in simple terms, is going to be market value of the property now versus what you paid for it. So with the way property prices have gone up over the many years, that could be a large amount. And for a gift that isn't going to create any value, it's effectively what we'd call a dry tax charge. That's a major consideration to bear in mind. So there's going to be an upfront cost. And it does take people conceptually some time to say, get their heads around, this is a gift. How can capital gains tax be in point? But it is. In fact, I seem to remember, and I've never looked back to find this, to source it, that someone objected so violently they went as far as the Court of Appeal. So that can't be, I didn't make a gain, I gave the asset away, and the judges said, sorry, that's not the way the regime works. So it is subject to capital gains tax. Also, we've talked about is a potentially exempt transfer for inheritance tax. So survive 7 years, it's outside your estate. Survive more than 3 years, and the rate of tax, inheritance tax, starts to taper away. Again, you're within this GROB, love that acronym, gifts with reservation of benefit regime. But if it's your second home, it should be easier to identify what the reservation is. And if it's a holiday home, let's say, you might be able to get a view on what the market rate is. And if you pay that market rate, then you won't have a reservation, because a reservation doesn't have to be market value. If you spent one night in a property, potentially, I think then the whole value would come back into your estate. But if you're paying market value, then should be free of that. But it's a bit of a painful process to go through. But so do it right. Go to your tax advisor, even if it's the second property, holiday home. And there's a final point just to add, which I have had people come up in the past and ask, trying to get too clever. If I make a cash gift to my children, they buy the asset and then I go and live there or enjoy it in some way as a holiday home, and I spend a fortnight each summer there. Is that all right? And we're not going to go into the detail, but there is a whole other regime called the Pre-Owned Assets Tax Regime, POAT, which will catch you. So if you think you're being cleverer than HMRC, answer is they probably got there before you. So don't go there. And again, it's go back to your advisor, because there's probably something that will trip you up.
Agreed. I think all the things we've discussed, it's not just weighing up the tax implications, it's also thinking about the practical points. You don't let the tax tail wag the dog. I was just thinking I was saying that the right way around. But it's weighing up that potential IHT at 40%, which may be difficult to fund because you've got no liquidity.
Yep.
Versus the various different factors of giving it away during lifetime and whether you potentially pay that CGT. One final point I would just make is that where you make a gain on a gift, you pay the tax. If you make a loss on a transfer to a child, for example, a capital loss, that loss is not freely available to offset against any other gains that you make. That is what's called a clogged loss. So actually you can only offset that against gains that you make on gifts to that same person. So there are restrictions to think about that as well. So if you think, I've got something standing on a loss, I'll use that. Well, that's great, but you just have to work out that you allocate it correctly. So well, thank you, Mike, for joining me today on our latest Safri's Private Wealth podcast. At Safri's, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain, and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It's important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Safri, then please do visit our website at www.safri.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found this episode helpful. Thank you for listening.